trigger SIP. So it's basically your investment happens automatically when a condition, that is a trigger, is met. Example triggers: market falls to 10%, market falls 10%, or net asset value drops below 50 rupees, index reaches a certain level. These are examples. So important beginner note: this is an advanced investing technique. Most beginners should avoid the trigger SIP. Right. Firstly, we'll discuss the pros. It can exploit market opportunities. Advanced investors may benefit. And automation with strategy. No need for manual monitoring. Cons are: it is slightly complex, requires market understanding, and timing markets is hard. Even professionals fail often, and can underperform normal SIP. Simple investing often works better. This is best for experienced investors or market savvy users. So we'll skip this. Like, we'll not invest unless we are advanced market investors, right? Fifth is perpetual SIP. Now, what is it? SIP continues indefinitely until you stop it. So there is no end date specified for this type of SIP. For example, instead of SIP from 2025 to 2030, you simply start SIP and let it continue forever. Pros are: it encourages long-term investing and excellent. This is excellent for wealth creation. Secondly, no renewal hassle is there. It is convenient and it supports compounding. Time is the biggest factor in investing. Cons are: it needs monitoring occasionally. Don't completely forget these investments, perpetual SIPs, and can continue in unsuitable funds if fund performance worsens. This is best for retirement investing and long-term investors. Sixth is multi SIP. So what is it? One SIP distributed across multiple mutual funds. For example, 10,000 rupees SIP split into 4,000 rupees index fund, 3,000 rupees flexi cap fund, and 3,000 rupees mid cap fund. Right. So we have split the SIP into multiple mutual funds. Pros are basically: it allows for diversification, money is spread across different fund types, and it is easier portfolio management. It is a single setup which is diversifying your money into different mutual funds. Cons are: it is over diversification is possible. Too many funds can reduce the efficiency, and it is harder for beginners to understand. Also, it may become confusing for some people. This is best for intermediate investors and long-term diversified portfolios. Now, SIP versus lump sum. It is very important to know this concept. Lump sum is basically invest large amount completely at once. For example, 5 lakh rupees invested immediately. And SIP is invest gradually over time. For example, 50,000 monthly. Now, SIP pros over the lump sum amount investment. Firstly, lower timing risk. It is important for beginners. Less emotional stress. Market falls hurt less psychologically, and suitable for salary earners. Lump sum pros over SIP. It would be a better in long term because long term bull market specifically, money starts compounding immediately. When you invest big amounts, they start compounding obviously due to the kind of money invested. It would increase, compound immediately, and it is useful when large money is available, bonus or inheritance, etc. Now, beginner rule: salaried income, you use SIP. Large one time money you have to invest, then you probably can do lump sum or maybe STP. Now, important term that is related is STP, systematic transfer plan. For example, you receive 10 lakh rupees. Instead of investing all at once, put in liquid fund. Transfer 50,000 monthly into equity fund. This reduces timing risk. So first you put in liquid fund and transfer the 50,000 monthly into equity fund. Now, SWP, systematic withdrawal plan, opposite of SIP. Instead of investing regularly, you withdraw regularly. Used during retirement. For example, retired person withdraws 30,000 rupees a month from mutual fund. That is SWP. Now, which SIP type is best? For most beginners in India, best combination is regular SIP and step up SIP later. That's enough for 90% people. Right. Now, common beginner mistakes that we'll cover. First is stopping SIP during market crash. Never do that. Actually, that is the best time to continue because people would be in a chaos, and most people would not take the risk. So the people who take the risk and when the market stabilizes again, they will actually gain from that. Second is choosing funds based on recent returns. Past returns is not equal to future returns, so don't keep that in mind. Do keep that in mind. Having too many SIPs, 3 to 4 good funds